We're excited today to show you the Freedom Loan option that unfortunately not a lot of people know about. The exciting part is that the Freedom Loan will help you pay off your home much quicker than a traditional mortgage and save tens of thousands or, depending on the size of the loan, hundreds of thousands of dollars in interest. I know it sounds too good to be true, but it is true, and it's definitely the smarter loan. If you've owned a home, you know this. Over the life of the loan, that low interest rate you received cost a lot over time. This scenario shows a traditional 30-year fixed rate loan, a $320,000 loan at 4.75% interest for 30 years. Even at that low rate, they're paying over $280,000 in interest and will ultimately pay over $600,000 for a $320,000 home. What we're going to show you is that the interest rate is not nearly as important as how much you owe and for how long you owe. This long-term picture shows that it takes close to 13 years before your house payment is mostly principal, and it takes almost 23 years before you've paid equal parts principal and interest. So would you like to have a mortgage that lets you pay principal first? So what is the Freedom Loan? It's a home loan that's combined with your personal checking account. I know this sounds strange, but we'll explain it more as we go on. The bottom line is that all deposits into your new Freedom Loan checking account go towards paying the principal first. Interest is calculated daily after the principal is lowered. We'll show you this in more detail next. A big advantage is that not only do you have access to your deposited funds, just like in your checking account, but you also have access to the equity in your home from day one. The final point also sounds strange. You do all this without changing your spending habits. You don't have to pay more to get the home paid off quicker. Your Freedom Loan checking account works just like your normal checking account except for a few additional features. In your current checking account, you deposit your paychecks, you pay your bills, you have access to your funds 24/7, and you probably earn low or no interest on the account. When you switch to the Freedom Loan account, you still deposit your paychecks, you pay your bills, you have access to your funds and the equity in your home 24/7, and as we'll see, all of the funds in this account go towards paying the principal in your house first. Here we'll show the effects of your deposits and expenses in the Freedom Loan account. The month 1, month 2, month 3 blocks are showing the total loan amount. This isn't to scale, but what it shows is that when you make your monthly deposits, they get applied directly to your mortgage balance. Remember, interest is calculated daily, so the day you deposit your first check, you pay interest on the loan amount minus your deposit amount. The gray part of the box is the part you pay interest on. As you pay your normal monthly expenses, your principal balance will increase since those payments will pull right from the loan. This shows a second deposit mid-month with more bills being paid later in the month. At the end of month 1, the money you have left is added to your monthly deposit and your loan balance is that much lower and you pay less interest. The same at the end of month 2 in that it is added to the third month deposit. As long as you're depositing more than you're spending each month, the principal reduction will have a compounding effect and you'll see a rapid increase in principal owned and a rapid decrease in interest paid. The Freedom Loan is a 30-year loan with 30-year access to home equity dollars. After your home is paid off, you have the option to keep the account open and maintain that access to your equity, or close the account. There's a $60 per year fee to maintain the account if you want to keep it open. This account has all the features expected in a full-service checking account: debit cards, checks, online bill pay, and ACH transfers. Deposits are insured by FDIC just like in a normal checking account. Now, this loan isn't for everyone and it's actually a little tough to qualify for. You need a 700 plus credit score, stable positive cash flow, and an overall generally excellent financial position. Take heart though if you don't qualify yet. Just work on getting yourself in a position to take advantage of this loan. It's well worth it. At this point, you might be thinking, wow, I've never heard of anything like this before, and you wouldn't be alone. However, this type of loan is very common in other parts of the world, Western Europe, especially the UK, Australia, and New Zealand. A 30-year term is actually rare outside the US, and there's a reason for that. Big banks make big bucks off of the interest and sell notes to each other for profit. You can feel comfortable to know that our lender has done over 10,000 of these loans worth over $6 billion and have had 0 defaults and an average payoff time in 7.6 years. Yes, average 7.6 years. So let's see how this works. Okay, let's look at a typical Freedom Loan customer here at A1 Mortgage. We're going to compare the Freedom Loan versus a 30-year fixed loan on a new home purchase. However, this same scenario can also be applied if you're going to use it to refinance your current home. We have a home valued at $400,000 with a loan amount of $320,000. We're calculating a 30-year fixed at 4.75%, and so their principal and interest payment will be $1,669. The only other information we need to run the scenario is your net monthly income. Now remember, this is net, so this is take-home pay, the amount that's deposited into your bank account, and your monthly expenses on average. So in this scenario, we have $6,000 monthly net income and monthly expenses of $4,000. So when we run this scenario, we get the Freedom Loan paying off this house in 10.6 years. That's shown by the gray line. And remember, the client didn't change their spending habits and had access to their entire $320,000 of equity throughout the first 10 years. The equity available is shown by the dark blue line at the top. After year 10, if you decide to keep this account open, the availability of your equity in the account slowly decreases until year 30. After payoff, you'll have the option to keep the account open and have continuous access to your equity or close the account. The Freedom Loan saved this client over $159,000 in interest, again, without changing their spending habits or really even trying to pay it off early. This was entirely based off of using their normal deposits and expenses and at the same time having access to all of the funds and their equity. And remember, this scenario paid off the house in 10.6 years. The average customer pays off their house in 7.6 years. So at the end, we have a happy A1 Mortgage client that paid off their house in under 11 years. They saved over $159,000 in interest, and they have a nice nest egg for investing or retirement. Here's something else to think about. This scenario was based on a monthly income of $6,000 and monthly expenses of $4,000, with $2,000 left over. If your scenario had more than $2,000 left over, the house gets paid off even faster. We can run your scenario based on your loan amount, income, and expenses, and we can calculate your payoff date. Just call and talk to one of our Freedom Loan specialists. Thanks.